Thanks so much for having us. I've got a great topic for you today. It's one of my favorites to talk about, which is scanning. And, it's probably one of the most important things for me as a trader because it's all about efficiency. As a trader, we want to be able to, I think, consistently identify what exactly we're trying to find. And as professional traders, we should know what we're trying to find when we go out to look for a trade or an investment. So if we know that, we should be able to scan for it to make life a little bit easier. And that's what I'll be focusing on today, is talking about scanning and how we can actually look for high probability opportunities using free online tools. So, of course, the disclaimer just up here. We'll be taking questions at the end. Go through any kind of stocks or different scenarios you want to bring up based on some of the tools we use here. So, of course, not a recommendation to buy or sell, purely for educational purposes only. So let's get right into it. We've got 45 minutes, so I wanted to kind of cut straight to the chase. Obviously, as I mentioned, scanning is very important for several reasons. One, because it helps make life easier, as we just talked about, but also because it helps take the noise out. And I think that's one big problem I speak to a lot of my students about when they come on board with us, is they've got so many different inputs of so many different tools they've learned or different strategies they use or you name it, Facebook, stock, Twits. So people are inundated with all these different ideas, and they don't necessarily all line up. So when you start trying to combine all the things you know and look at all the different resources you have, you end up further away from a confident answer than you were at the beginning. So this kind of analysis paralysis is crippling. So with scanning, not only does it help make life easier, but it also helps us to strip away a lot of the garbage or the news, or noise, I should say, so we can focus in on opportunities that all have that same underlying qualities or variables that should hopefully allow us to create that consistent result. So, so how do we build a scan? Essentially, when we look at some of the different ideas that we can incorporate into scanning, here's some of the main ones that I've used throughout the years. Firstly, we've got P/E ratios, insiders, dividend yields, patterns, and they're all different things. And some of these are going to be more conditionally based, and some of them are going to be trigger-based. So does everyone here know the difference between triggers and conditions when building scans? Have people played with these ideas before? Okay. So the difference is, when we're starting to build a scan, we want to identify qualities that can kind of fill the backdrop to the stock. So things that make the idea feasible. So conditions might be, for example, the price-to-earnings ratio. We might be looking for stocks that have that very highly speculated value. We might be looking at dividend yields. So maybe we're looking for stocks that are going to weather the storm better than others, and we're looking for longer-term investments. We might build dividend yields into the scan. Of course, we can look at what insiders are doing. Maybe we have a high P/E ratio and a lot of insider selling. All these different types of things would be called conditions. And they're conditions because they don't really change day to day. So looking for insider selling, that might have been the case for 3 months. Same with P/E ratio. It might have been 500 for the last 12 months. So all these conditions, we'll get into this here in a moment when we start bringing up the scanning, but all these different conditions tell us that maybe the idea is right, and there's a sound reason for why the stock should go up or down at some point, but they don't tell us the when. They don't give us the timing. And so that's where we start to get into triggers, things such as patterns, strategy-based scans, indicator-based scans, where we're focusing on the price as not so much as the story. So let's go through an example. of building out this type of process. So when we go into, let's say we were going to create a scan just off the cuff. We wanted to, this wasn't going to be something we were going to use every day. Let's just say we were looking at the market and we were going to create our own scan based on what we felt the market was doing at the moment. And this is the kind of, if you start to think of scanning with this structure, you can create very powerful scans on the fly that allow you to do these types of things. So the way we start out building the scans, we think of an idea, and we say, now what kind of hypothesis are we trying to create? Well, let's say that the idea we have at the moment, let's say we feel we're going into that anxiety mode that Hubert was talking about. Maybe we feel that the market is falsely strong. And while it may have rallied, we think that stocks are maybe just beginning their downward descent. So that's the backdrop that we want to, that we're operating with. Well, the next thing we would then need to do is we need to say, well, what types of stocks, if we were right, would suffer? Which ones would be the most susceptible to weakness? Well, this is where we bring in our conditions. And we say, all right, well, let's look for stocks in a weak sector. And to identify the weak sector, we can look at the charts of each of the spiders and see which one has the smart money flowing out of it. So we look at the weakest sector. We might then say, okay, well, let's then also look for stocks that have a very high P/E ratio. So stocks that are selling at, say, 1,000 times earnings. You know, so for example, if they're making $1 million a year, but they're selling at a price valuation of $1 billion, well, that's a very high multiple. Why would a company have such a multiple? Well, if they were expected, of course, to be making a lot of money in the years to come because of whatever they're developing. So when you think of it rationally, just think of normal human behavior. If this company was so valuable that it's selling at 1,000 times of what money it makes, then it would be odd to see heavy insider selling, wouldn't it? To be giving away their golden nuggets. What would also be interesting or peculiar to see is if the institutions were also selling at the same time. So the people that know the company best, in essence, feel that the company is a good price to sell at right now. And then, of course, other things we can combine with that are things such as high price-to-book ratios, other fundamental factors that basically tell us that potentially the core of the apple is rotten. But now we need to know when will it fall from the tree, right? This is when we need to start getting into triggers and so forth. But before we go to that, let's just build out this example in a free online tool that probably many people here have used before, which is Finviz. So I'll just bring that up. Has anyone here not used Finviz before? But a very good program. Basically allows you to visualize ideas very quickly. So we'll go in here, it's at finviz.com, and we go into Screener. And basically we can start building out any kind of real idea through this drop-down menu box. So I'm going to bring up all, so we have all of these different 3 tabs on one screen. And we'll build this out very easily. Insider transactions, negative. Institutional transactions, negative. Okay, let's say we felt that basic materials was a weak sector. So there we go, we've selected a sector, negative, negative, basic materials, and then we can go to price to earnings ratio, high, above 50. And you can see that basically then narrow the market down to only a few stocks to just a few stocks that we can then break down based on a chart. So this is where, once we've got our short list, we can go over and click Basic. Okay, so we can go there and we can click Basic, and you'll see that the chart will actually, all the different charts for the stocks will then populate underneath, so we can just quickly scroll through. So we've got all of this set up here: negative institutional, high P/E ratio, weak basic material sector, insider transactions, and then you can see that we've got our 3 charts that pop up down below. So this is a great way just to build a basic scan to start looking for these types of opportunities. Now, once we've got these charts, of course, we're looking for triggers. We're looking for a reason why we may want to short that, or why it might be an appropriate short right now. So, you know, of course, you've heard a couple of speakers today talk about head and shoulder patterns and so forth. So this is where your technical analysis skills really do come into play. So if we were looking at ASH, for example, somebody who's familiar with head and shoulder patterns may notice that on the macro time scheme, we may have that head and shoulders. It's called a complex head and shoulders because we actually have a left shoulder and a second left shoulder and then a possible head in the middle, which would, so that's just an idea at first glance what you may have there, and then a drop down to the neckline, a second shoulder, a possible another shoulder, and then a drop even further down. And that's basically how that pattern would potentially pan out. So you could get a you know, possible short from this 115 down to the 95 area. So a possible option play, possible stock play, but this would be the starting point of how you would use that type of an idea to build out the scan. Now, once we've then got, now because we're using a backdrop of understanding the insiders, it's always valuable to actually look at exactly what, just to confirm those conditions. Again, if it's going to be the driving force behind our idea, we want to have a bit of a look at where that idea is coming from, or in other words, the exact type of insider action that's happening. So on this example, ASH, we can see that the insider transactions were negative 26, institutional transactions negative 4. We have a high price to earnings ratio, poor earnings per share, poor earnings reports. So now we can go into and have a look at the insider action, just to dig a little deeper, and go into Insider Cow. Great website, free website, and we can just simply type in the symbol here, ASH, and there we go. So we can now see which transactions have actually occurred. We can see you know, how widespread is the selling. Again, these are all conditions, and then we can also look at the institutions and see if there's been any kind of recent large selling or buying. So you can see the selling represented by an S, buying represented by a B. And if we actually want to get even trickier, we can also just have a look at what the insiders or smart money is doing on a sectoral or industry basis. And we can go in and actually click industry. And it just takes a few moments here. But you'll see what it does now for us is actually go in and take all the insider action within an industry or sector group, and then we'll graph it for us to tell us whether there's been significant insider buying or selling, and where it's come from. And you can actually then go in and see other companies. So it's a very, very useful tool. And this is just one idea of how you can build that initial scan. Now, So then as we start to look at such triggers and indicators, when we start to bring the stock over to our charts, now this is where we get into the technical analysis. So at the beginning, this is all fundamental, condition-based. Then we go to the technicals and we start to look at some of those more important things, such as the triggers. What is the price doing right now? What patterns do we have? And then once we know all of this information, we can then complete the picture by looking at some of the indicators, such as an increase in volume. For example, as the stock drops, we want to see that momentum increasing. A negative MACD, so we can see that there's a momentum down, as indicated by that. And then in markets like these, where, of course, December can sometimes start flattening out with a lack of volatility, we may want to look for ADX, which is indicates movement. We can maybe want an ADX value above 25 to make sure that basically when we have the full picture, we have a stock that's a weak sector, susceptible to weakness, the insiders are selling it, it's breaking support, it's got the volume is increasing, so more people selling it with lots of movement. That's basically what this recipe would tell us. And if we bring that over to the chart, just to use this to complete this example, I'll just bring the chart up here. If it will cooperate with me. Okay. Oh, there we go. Can you use Insider Cow for Forex and commodities? Insider Cow just works for equities, as far as I'm aware, but there are other tools you can look at for looking at block trades and institutional trades and so forth. I'll just we'll go over here. We'll go to Ash. So as an example, we've got that on a longer term time frame. We have that head and shoulders pattern potential. It's an even if that was the case, it would be an even stronger head and shoulders because you have a declining neckline. So when you have a declining neckline, that's a much higher probability than something that's going flat or going up. So look at our short-term moving averages. We've got the 20, we've got the 9. We can see we're rolling over that. We've just broken key support. So we've broken the trend line support. We've broken the moving average support. We've gone beneath the two moving averages, and so far we've been closing in the bottom half of the range on almost every day since the 10th of December. We can go to our MACD. We can see we've turned negative on the MACD. And we can look at that ADX. Oops, here we go. Go to our ADX, which is in directional movement systems. And you can see if we look at our ADX, this gray line, it's well above 25, indicating we have lots of movement. Now this is just this has actually played out quite well because I hadn't. This is a scan we've just run live, but this would be a stock that meets all the criteria that we'd be looking for right off the bat. And so, you know, this is the kind of thing that just goes to show a kind of a scan in process. And there's a short-term target. It's the kind of thing that I would buy puts on down to the 110 mark. So it's got that nice setup. All right. So so moving forward, it's basically, you can see the way that we want to construct the trade is always through a very start through finish kind of process-driven way, and always wanting to kind of go through things without feeling. So as a trader, I'm never concerned with whether I'm right or wrong. That is not the objective. It might sound funny. The objective for me is not to be right. The objective for me is to follow my rules. And if you have proper risk management in place and you follow your rules in a process-driven method, you should be able to get consistent results without even having to get it right more than 50% of the time. So this relies on having a process that you go through, a series of checkpoints that you can follow without having to worry about whether you feel good or not about the trade. You're simply answering questions that will lead you down a path to a yes or no decision. And remember, that's how billions of dollars are made in the stock market. It's not from people thinking they're right. It's from high-frequency trading computers that simply follow rules. So if we're going to try and make the similar results to these big high-frequency firms, let's follow some rules. And here's the rules that I followed when deciding what type of scan to run, or what kind of idea I'm going to create or use. Firstly, is the stock market bullish or bearish? So at the beginning of every day or every week, depending on what type of trader you are, the question we want to ask is the market bullish or bearish? Now, a lot of people answer this question by looking at economic data, unemployment numbers, or maybe what the talking heads are talking about on TV. And as a technical analyst, I have real problems with that because it's so subjective. And so depending on who you're listening to or what opinion you have, it could create a completely different answer. So I prefer to deal with things that are defined, things that are quantifiable, measurable, and therefore repeatable. So when I look at a chart or look at the market, I don't care whether it's bullish or bearish. What I want to know is it at resistance or support? And if you draw your lines properly, you should always be able to answer that the same way. And then we apply the same logic then to which sector is bullish or bearish. So which sector is at resistance or support? And if we can find that the market is at support, and we find a sector that's at support, then we know the area that we're looking to buy at. We're looking to go bullish on company X, stock XYZ. And so to do that, we can then run our correlating scan, just like we did now, pick the weakest or strongest sector, and then we can start looking at things like the smart money and looking at where the smart money is going. Is the smart money loading up or is it loading out? And then again, go through the same process of once we've checked all these boxes, do we have supporting price action patterns? Do the indicators confirm? And are there any special ingredients that give us an edge? And then once we've started to get into the pattern of thinking this way, scanning is obviously the way that we can start cheating a little. So I talk about the thought process behind how to create a scan and the building blocks that go into it. Just like what I learned to use a power drill. I was forced to use the normal manual way first for the first 6 months, because if I couldn't appreciate a screwdriver, I shouldn't be allowed to be using a power drill, was the thought process. And the same with scanning. You don't have to go in and do all this manual work that I'm going through here. But this is the process that goes into it to create an effective scan. So let's just go through some of these steps now. So again, once we start to look at the market, bullish or bearish, is replaced with, are we at support or resistance? Patterns. You might have seen some of these mentioned from some of the other speakers today. Some of the high probability patterns I'll focus on are double tops, W's, head and shoulders, inverted head and shoulders, every single one has different probabilities. Here are some other ones. Obviously, falling wedges, which are bullish. Rising wedges, which are bearish. So you have a contracting range. Even though it's going up, that is something you would short. Flag formations, very, very bullish. Saucer patterns or frying pans or fallen angels. There's quite a few names for this type of formation. Bullish. Double tops. And so as you start to get into the world of scanning, the key thing to identify is that there's about 60 plus different types of patterns out there. And they all have different personalities, so how you would identify them. They all have different probabilities, so if you took 100 of them that all looked exactly the same, how many would go up? How many would go down? How much would they go up? How much would they go down? So the key thing as you start to now build on your scanning and adding patterns to it is to then focus on several patterns that are high probabilities. So the ones that suit the time frame you're trading in, that have the highest balance of probability of success as well as profitability. So it's no good being right 80% of the time if you only make 5%, but the 20% of the time you lose 50. That's not a good strategy at all. We want something that's a nice balance between highly probable and highly profitable that you can find enough good trades on that we can make decent returns. So I'm just cycling through again these types of patterns that I like to focus on. The head and shoulders, fallen angels, pennants, flags. Flags are fantastic. Big breakout moves. And then the time frames that you then want to use to confirm these patterns when you find them. Now going into, so to look for these, we can actually then go back to Finviz. And if we bring up the screener, what we may also do is we can change now from a condition-focused scan to a pattern-based scan. So you can see we're actually going to take the sector off. We're going to say, all right, we're not too worried about the sector. So what we're more concerned about is we want to make sure that rather than the sector being there, we want to look for the pattern being there. So we have 54 stocks that have high P to E ratios, insider and institutional selling. So there's not a lot already. I mean, 54 isn't many to go through. But let's say we wanted to shorten that up and use a pattern-based scan. We can then go in here under pattern, and you'll actually see many of those different patterns I just talked about here in the list. Channels, head and shoulders, inverse head and shoulders, multiple bottoms, ascending and descending triangles, and so forth. So we can go in here now, and if we're looking for insiders selling, institutional selling with high P to E's, well, now we can go in and look for a bearish pattern to boot. So we can put in, for example, that head and shoulders. And you can see it's tried to find us, therefore, head and shoulders. So left shoulder, head, right shoulder. But this is already kind of a bit long in the tooth, if you know what I mean. It's already started to play out quite a fair bit. So if we started to reduce the kind of conditional-based criteria, you can start to see you can then get into a short list of stocks that are then meeting your parameters. So high P to E ratio, high forward-looking P to E ratio, insider and institutional selling, to get the idea, this is when you start combining in here we go. Can everyone see the chart there? Okay, RNY. Yep. Okay, good. All right. Now, so once we've got the backbone of the idea, we've got the pattern, then and only then, do indicators really start becoming really effective, because that's when we start to be able to build a confirmation, because really technical indicators are just answering a question, and we need to know what question we're asking. So if you start combining, for example, momentum indicators with oscillating indicators, it's not going to work very well. If you're a momentum trader, for example, you would want the RSI to be going up over 30. That might be one of the strategies I use. That's one of the buy criteria on a momentum trade. So RSI going up over 30. However, if you're dealing with an oscillating trade, then I want the RSI to be as close to 0 as possible when I buy. So using two different strategies, you're looking for something completely different from the indicator. And so this is why it's important to know what recipe we're working with and to know what ingredients we're trying to put into it. So just to give it, so some of those examples of where people often misuse indicators. Let's go forward here. So let's start with Bollinger Bands. So Bollinger Bands are for oscillating trades. What we're going to be wanting to look for is where the stock is ideally piercing the outer band. So we have, for dealing with an oscillating stock, we want to now look for stocks that are, when we go to the chart, that are beneath the band for a long or above the band for a short. You can see that we're also looking for that to be matching up at resistance. So we've got this double top. That's the pattern, the double top, further enhanced by the fact we're outside the Bollinger Band, or a double bottom at the lower side. CCI. CCI is another overbought, oversold type of indicator where we're looking for it to be outside its band. So we're looking at a 200 period on CCI for oscillating stocks, like Head and Shoulders, for example, looking for that to be outside the bands. Okay, now the final, another example here now as we start getting into different types of scans we can use. Is we can look for contrarian scans or looking for ideas that are not as obvious. And again, if you think of the market as your playground, and you get over the idea of kind of being scared off by it or intimidated by it, sorry is the word I was looking for. If you stop being intimidated by the market and start to see it as something that's putty in your hand to mold, this is when scanning can become really fun, and trading can become as fun and as profitable as it should be. So here's an idea, for example, that is one of those kind of creations of thinking a little bit outside the box. It's called my short float scan. So obviously, if we've got a stock that is heavily shorted, right, this means that people are betting against it. They're shorting the stock. But there's going to come a point where they have to cover that short. They're going to have to buy it back to take profit. So this obviously creates what many of us will know as a short squeeze, which is a very dramatic rally off of a point of interest where buying occurs. The stock starts to go up, and all of a sudden, everyone shorting the company has to buy to protect their profit and avoid any losses. So these short squeezes can happen on terrible companies. I mean, that company might be bankrupt in 6 months, but on its way down, it might have a 30% rally in 2 or 3 days because of these short squeezes. So one type of contrarian trade, which is purely technical in essence, is looking for heavily shorted companies that are obviously dropping, and then looking to see technically on the chart where is that key support level where buying could kick in, triggering a short squeeze. And to make this, to make the conditions behind this even a bit stronger, what we can then do is we can add the presence of insider and institutional buying. So not only do we have a key technical support level helping the stock to rally, but we've also got the smart money starting to step in as well. So it just further adds that background of potential health to the company. All right. So let's bring that up. So we go float short and go over 30%. We want positive insiders, positive institutions. We're not worried about the pattern at this point. We're just looking for our list. And then we get 21 stocks that meet the criteria. You can see the short float here represented in that number. So as you go along, this is where we're now looking at the chart to identify a key support level that the stock is approaching. And this is where, this is something like, for example, CSLT was actually one, for those of you who follow our executive summaries, this was one we actually picked as a long in early November from this very same scan. So it came up as a criteria, and was just a long for a little 10% pop from 12 up to that $14 target, just under 14. This could still have some room to run, but this is an example of just a short-term little squeeze here from 11.59 up to 13.40. So you've got basically a $2 run, or 16-17% in just a few days. But that's the process you want to go through then, is now looking for those key patterns and stocks approaching those key support levels. Now we don't have a ton of time left, just a little bit under 10 minutes, so I'll be taking some questions here, and we can bring up stocks here in a moment that people might be interested in. But this is a very, as you can see, very good tool for starting to build out ideas. You can build, and this is one of the tools that I use to search for explosive option moves during earnings season, because you can also filter by when the company is reporting earnings, as you can see here. So during earnings season, there's a very specific strategy I'll use for searching for those types of opportunities, and really the sky's the limit. All right. So as we start to go into the kind of the period of the market we're looking at, the very last type of thing that I'll touch on is smart money. So I've talked about smart money. I talked about in terms of insider and institutional buying as it relates to kind of building conditions behind the trade. But one final thing that I'll use, which is very important, is scanning for when smart money on a day-to-day basis as a trigger is starting to accumulate or get out. Now, in most conventional methodologies, when we look at charts, the definition of an uptrend is higher highs and higher lows. But I would argue that's wrong. It's faulted. So it's faulty. Higher highs and higher lows, sure, might be one aspect of an uptrend, but we need more than that. So when we're looking at higher highs and higher lows, if the stock was making higher highs and higher lows but contracting in the range like that, that would be a short. That would be a rising wedge. So that doesn't work. What if we have higher highs and higher lows and the range stayed the same? What if as it did that, the volume was dropping? Would that be a trend you'd be interested in? Not me. That's telling me the trend's coming to an end. Even worse, what if as the stock was going higher highs and higher lows, what if it was closing in the bottom half of the range? That would also not be something I would be interested in at all, other than maybe to short it, because that's a reversal pattern and it's probably about to drop. So if we're really going to look at a true uptrend, what do we need? We need higher highs and higher lows. We need, and what is that? What indicator tells us that? Directional movement. We need closes in the top half of the range. What indicator tells us that? Stochastics. And we need increasing volume, which a lot of people will look at on balance volume and things like that, and so forth. And then
hey, John, don't mean to interrupt, but you're looking at about 4 minutes left.
Thanks very much, then, mate. Okay, so what most people end up with is they end up with this. They end up with indicator paralysis. So one of the things I like to use, which looks at all of the things I mentioned, is money flow. And so one last thing I'll look and scan for is look for scans that identify when the smart money is buying. And the smart money is buying when the volume is going up, the closing in the top of the range, and we're making new highs and higher lows. And that's when you see that this green line down the bottom will begin to climb. So in a lot of the key trades that we've been doing recently that have come from some of the scans I've shown you tonight, such as this one that we're currently short, Red Hat. This was a really easy short because if you look at the pattern, this was in a weak. It was in a weak sector. The market was going higher, but this had broken down through key support at 62. The insiders were selling, and you can see the money flow was much lower than previously it was at lower prices, and then dropped right away. So this was a nice, easy short down from 62 to 58. All right, so I've gone over quite a fair bit of information today, and hopefully that's people have been able to catch on to a lot of it in terms of the thought process. Again, like, you know, stock trading is all about efficiency. I mean, we don't trade because we want a job. We trade because we want money to work for us, I would assume. So the scanning is a key component for that. And if you can start to scan efficiently, we should only be spending about 30, 40 minutes a day on per strategy versus watching for the stock to come to us. The course that we're offering today, that's something that is very, very important with these times. We've got a market that a few of the speakers have talked about. We may be rolling over here. So we have a very special course coming up, which is called Capturing the Crash. Now, it's actually not just 2 hours. It's actually two 2-hour sessions, but 4 hours long. And what we cover here is all of the momentum indicators, So directional movement, MACD, volume, money flow. We're going to be talking about basically the setups that allow us to look for these high probability patterns that I've talked about earlier. So we've gone through some Finviz scans, but in this basically we're going to be teaching you some very specialist strategies that we use every day at Acorn for our corporate trading fund, and showing you how to set up the scans, how to shortlist the scans into tradable opportunities, and how to execute step-by-step processes to make sure that your results are consistent. So it's actually the 2-hour workshop is actually two 2-hour workshops. So it's about 4 hours in total. And it also includes the DNA of technical trading, the ultimate trader's toolbox. And this is where we go through a step-by-step, process-driven way of how to answer all these questions. How to figure out exactly whether the market is bullish or bearish, whether it's going to break support or bounce off it, and what basically the different types of indicators and things we use to confirm that. That's included. So essentially the entire package is comes with the Capturing the Crash workshop. It comes with the Stock Scanning workshop, which is an extension of today. And of course the DNA of technical trading. We also include the Smart Money indicator that I was talking about today and show you how to use that. That also comes with a 1-hour video on how to install and implement it to identify highly profitable trades. And as one of the specials we've included with this, it actually comes with one-on-one support. So for everybody in the course, that's why we do limit it to the first 20 registrants. You will actually be receiving one-on-one training with one of our coaches at Acorn, so that as you start to implement the scans, we will help you to build your own personalized scans and obviously implement the ones that we've been teaching. So it's acornwealthcorp.com/crash. And the stock scanning workshop, Capturing the Crash course, and are actually both recorded, so you receive those instantly. You also receive the DNA of technical trading instantly, and we'll be hosting a live session of each of these 3 in January, and you'll actually be able to then attend those live as well. And that's one of the things, is you can attend any of the courses as many times as you want live for live. So if you have any further questions, we're out of time here, but if you have any further questions, please do give us a call on the number down the bottom, or shoot us a quick email.